Yeah, we like to break our assets down into three broad categories. And these categories are based on what the asset is actually used for rather than what it is. So firstly, we have our lifestyle assets, and these are the fun ones. And if anyone's read Rich Dad, Poor Dad, we know that he reminds us quite regularly that even our family home and our lifestyle assets cost us money, so these are really liabilities. If these are the assets, the only assets that we owned for the rest of our lives, then we would have to work forever. Our next category there are our nest egg assets, and these are the ones that we want to accumulate along the way to be able to stop work eventually. Our definition of these is quite simple. So these are assets that pay us a positive cash flow without us having to spend too much time or money on them. So in theory, we could go away for a year or more, and they would keep paying us an income. Sure, we'll need someone to help us manage those assets, but that's an easy process at the end of the day. Our next one there is our active assets, and these ones need our time and money for them to keep going. A business that we currently work in is a good example, or a negatively geared property or negatively geared share investments. Active assets, they're the ones that are a way to really build your wealth quickly. But as always, can anyone tell me, when we're chasing higher rewards, what do we get on the flip side of that? That's right, we get higher risk. So we need some good strategies in place to make sure that we're managing those risks. Now, you'll also note here that the same asset could fall into any category depending on what the strategy you use. So take my family home for the moment. At the moment, it's a lifestyle asset because it's costing me money. If it was bought by someone with no loan or a small loan, it would be a passive asset for them. If it was bought by someone to renovate or as a negatively geared investment, it would then become an active asset.